Hello to everyone. Today I am here with Trade Risk Part 3. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel. In this section, we are going to cover import process and documentation, letter of credit opening, parties to letter of credit, exchange rate risk, and ways to mitigate risk. Import process and importer is a purchaser to buy initially inquire about the goods, asset, or the services that meet its requirement. If all requirements are met, will further pursue to inquire about the price, delivery time, delivery mode, shipment charges, insurance charges, freight charges, payment mode, payment terms, confirmation about no sanction imposed on the import of assets or the export of assets, prior import approval from the central bank if required, tax, other tariff, etc. These all information, or if there is any additional information, you should think about it before entering into the contract. After the fulfillment of above inquiries, the import documents initiate. Import documents process. Proforma invoice is the document that includes all the required information and the terms agreed by both parties, or there is any other document that is in practice in your country, you should adopt that document as a part of your initially agreed terms. The to both parties are include the importer and the exporter. Proforma invoice date and number with the addresses and the contact of both parties. Nature of asset, or so there are services or the good with make, model, and services term or unit price. In case of services and goods, with the specification and features, it's very important because a same model machine may have the different features. Modification, amendment if required, allowed or not. It provides the cushion that after placing the order, there is a cushion for the modification or any change of the terms that may be agreed between the both parties. Delivery time, delivery mode by ship, by air, with date. Transit, allow or not allow. It's very important. Either you can change the goods within uh, coming from one country to other. It's allowed or not allowed. Payment mode, either it's by letter of credit. If in case of a letter of credit is transferable or not transferable. Is it a site LC or a user's LC with the term of 30 days, 60 days, 90 days, etc.? Insurance coverage means marine insurance from port to port or any further coverage. It means the insurance, inland insurance is also included as a part of Proforma invoice or not, or the importer have to manage himself within its land. Performance guarantee by offshore bank. Now, if you are importing any plant, in that case, we require the performance guarantee as well. Either the plant, if the plant not become up to the mark or not producing the product according to your standard, required standard, which are agreed. So it should also covered by certain type of the document. LC opening in case of the import, normally payment through the letter of credit is preferred because it provides the protection to the importer. No payment obligation arises until the goods has been shipped as promised and the assets are also inspected by the third party before the shipment and provide the protection to the exporter. Means third party inspection provide the protection that the products are delivered according to your specification or not. The bank will pay the Exporter if the buyer does not meet the obligation. So it's then also the protection for the exporter. An import letter of credit is issued by the buyer's bank and received the seller's bank. Letter of credit open based on Proforma invoice terms accepted by the both parties. Full description of the asset, services, goods along with the price should be ensured while opening the letter of credit. Parties to the letter of credit, the exporter seller, exporter beneficiary is the recipient of the LC, importer buyer, importer applicant, the customer requesting the LC to be issued. Issuing bank give the written undertaking. Advising book bank confirm, also called the confirming bank. Seller's bank, that is the bank that advise the letter of credit to the beneficiary. Foreign currency risk, it's very important because exchange rate is a major issue when you are dealing between the currency having the soft country having the soft currency and the hard currency. The chances of the money lose due to the currency fluctuation of any business involved in the international trade. Foreign exchange risk type, the transaction risk, if the supplier's country appreciate or buyer's country depreciate, the buyer will have to pay more in its base currency to meet the contract price. Translation risk, exchange rate change having the direct impact on the company's financial statement that change the value of company's equity, asset, liability, or the income as a result. Economic risk refer to have the impact on the company's market value for exposure due to the unexpected currency fluctuation that can affect the company's future cash flow and the foreign investment and earnings. Possible ways to mitigate the risk. Risk against the import. Importers concerned regarding the asset verification and the payment to the distant supplier. LC is the way to mitigate the risk of the third-party inspection of the asset and no payment obligation till the shipment. Exporters come concerned regarding the payment receipt from the distant customer. LC protect the exporter and the bank will pay the export if the buyer does not meet the obligation in time. Asset and the good damage insurance coverage provide the protection both against the marine and inland damages or losses. Currency fluctuation hedging provide the currency fluctuation risk coverage. Asset performance and good quality offshore bank performance guarantee cover mitigate this type of the risk. Delay in the delivery, chances of the delivery delay risk sharing should be addressed as a part of Proforma invoice, or you can make any other agreement to address this issue. Tariff clause, tariff changes, clause of uncertainty regarding the tariff change should be addressed in supplier's agreement. If you are importing some raw material to meet the order of any of your customer, so in that case, in that agreement, you will incorporate the clause for the change of tariff to mitigate this risk. Thank you very much. See you again with the upcoming videos on banking and finance related topics very soon. Thank you very much.